What if I told you that the most important part of stock analysis takes under 1 minute, but it's the one that most investors skip entirely? It took me over a decade of professional investing to figure this out. I'm Gary Mishuras, managing partner and CIO of Silver Ring Value Partners. I also teach the value investing seminar at Babson College. Over 25 years of professional investing, I put together what I call the Pulse framework, tying together 5 fundamental signals from all 3 financial statements to quickly tell which stocks are worth my attention. And that's before I listen to management commentary or read potentially biased Wall Street research. This has saved me hundreds of hours that I then was able to reinvest in research in stocks with high potential, which is very valuable. The Pulse framework stands for economic profits, underlying free cash flow, leverage, smooth free cash flow yield, and EV cap rate. And if you give me 5 minutes, I'll explain exactly how it works and I'll show you how I apply it to 3 stocks of companies that you care about. All right, let's define the Pulse framework and why it's so useful for our analysis. So, first, we're going to talk about the P, which is economic profits. So, you might be wondering why use economic profits instead of return on invested capital? Isn't ROIC a better metric? Well, it's not really. Think about it this way. Would you rather have 20% return on capital or 15% return on capital, right? That was actually an interview question I got asked 25 years ago when interviewing for my Fidelity Equity Research position. Well, the answer is it depends. And depends on what? On how much capital can be invested. So, for example, you probably would rather have 15% return on capital if you could invest $1 million at that rate than 20% return on capital if you could only invest $1,000. So, economic profits is great because it combines both the rate of return on investment and how much capital can be deployed at that level of return. So, next, we're going to talk about U, which is underlying free cash flow. And the reason I'm adjusting regular free cash flow by subtracting option expense is twofold. One is options is clearly a real economic expense. We don't need to argue about that. And two is, listen, this is imperfect. There are many adjustments you can make, but the whole point of this framework is to quickly tell if a stock is interesting or not, right? It's not to get super precise. So this method gives us a very quick and approximately correct way of adjusting things without getting into too much minutia. Next, we go to the L, or leverage. So financial leverage is very important. And again, the goal is not precision. There are many ways you could potentially analyze leverage, but the goal is to approximately tell is the company under-levered, approximately correctly levered, or over-levered, which could be a red flag that you want to investigate before deciding to do further work on a company. So here, we're just using net debt divided by EBITDA. Pretty straightforward. The fourth component, which is the S, is a smooth free cash flow yield. And this is really the best single metric for valuation that I know of that's quick. The idea here is to take 7-year average free cash flow, which hopefully is roughly one economic cycle, and bring it forward to a forward 12-month basis. So it's kind of equivalent to a forward free cash flow yield. Again, it's imperfect. There are many things you could do differently, but for a quick metric, I don't think there's any one metric I know that beats that. However, we're going to get to the E in Pulse, which is EV cap rate, and that's a great metric to supplement smooth free cash flow yield. And the reason for that is twofold. The free cash flow yield that we're using is equity free cash flow yield. EV cap rate, by definition, right, is an enterprise value metric, which takes into account debt, preferred equity, and things of that nature. The other thing is, for the free cash flow yield, we're using a trailing 7-year average. Here, we're using the last 12-month data. So this is a great complement secondary valuation metric to check as well. So there you go. There's your Pulse framework. And now let's dive into the interesting part, which is applying it to 3 examples of companies that you actually know. All right, let's start our walkthrough through 3 examples of using the Pulse framework in action. So I'm going to look at the spreadsheet over here. And we're starting out with Microsoft, one of the examples we used earlier. And you can see the economic profits are amazing. They're positive and they're rising over time. So that's great. Looking at the underlying free cash flow, it's also a pretty impressive chart. You got basically rising free cash flow and a pretty nice conversion ratio, right? You got about 75% or so free cash flow to net income conversion. Now let's take a look at the L leverage, which is pretty good. And we're 0.5 times net debt to EBITDA levered, which is a very safe level of debt. We don't need to spend much more time there. Valuation is where it's at for Microsoft, right? You got a smooth free cash flow yield on a 7-year basis of about 2%. That's a pretty low yield, meaning very high expectations. If you look at EV cap rate, which uses the last 12 months profits, you basically have 4.5, which is much better, but it's still not a very attractive valuation. So if we were to summarize the Pulse framework for Microsoft, you basically have a very nice company with a fairly high price. All right, let's switch to the next company. And I'm going to type in the ticker here so you can see it's not preloaded. It's loading data from Bloomberg. So I'm going to type in Novo Nordisk, which is a company that people have been focused on recently. So let's see if we can get that loaded. All right, so we have Novo Nordisk. It's loading. Give it a second. There you go. So let's do the same thing, the Pulse framework. So the economic profits, very nice, positive and rising. So great over here. Underlying free cash flow, also amazing. Free cash flow is increasing. Conversion between free cash flow and net income, about 80%. That's great. Leverage, very similar to Microsoft, less than 1 times net debt to EBITDA, so a very safe balance sheet. Now, interestingly enough here, you have much more attractive free cash flow metrics. The smooth free cash flow yield on a 7-year basis is about 7%, which is a pretty good number for a company that historically has grown free cash flow in the double digits. And on an EV cap rate basis, you have an EV cap rate of almost 9%. So Novo Nordisk falls into good company and interesting price. Again, we're not trying to figure out if it's a buy. Just remember, we're trying to figure out if essentially you want to do a lot more work. So based on this, you would say, yeah, this is something I would want to do more work on. All right, let's take a look at our last company. And let's just pick IBM because we used it earlier. So let's load that in. Give it a second or two. Hopefully not too many seconds. So it's loading the data. And here we go. So we have an economic profit chart that tells us a pretty interesting story, right? So this is IBM that was doing well. Economic profits were rising. Economic profits started to fall and kind of stabilize in recent years. So you can see this is a company that probably the economic profits chart is telling you it's probably in its maturity. Underlying free cash flows are okay. They're positive. That's good. However, they're not really growing. They're kind of flat down over time. But the free cash flow conversion rate is nearly 100%. That's pretty good. Leverage is reasonable. It's in the kind of solid investment grade category, just under 3 times. So nothing to worry too much about there, but it's certainly not as strong as Microsoft, for example. So I wouldn't worry too much about that here. Now, the smooth free cash flow yield is kind of not great, right? So you have a 7-year free cash flow yield of about 5%, 5.5% here. And that's not really that amazing for a company that has had free cash flow that's been flat to down. If we look at the EV cap rate, 4% is not particularly attractive, right? So I would say this is a company that's good. It's not growing, but maybe not as good as it was one day in the past. And the price is not that interesting. So again, I would put this in the category of good, decent to good company, not particularly interesting price. All right, so we went through 3 examples. This is how you use the Pulse framework really quickly. Obviously, you can spend more time on each component if you want. And of course, you want to start with the Pulse framework to save you a lot of time. You don't want to stop here and make a buy decision. You want to do your own research after this. So that's the Pulse framework in action, tying 5 fundamental signals from all 3 financial statements to answer a simple question. Does this stock deserve a deeper look right now? Sometimes the answer is yes. Sometimes it's not yet, but at a different price it might be. Other times it's clearly no, it's a pass. And that's all in under a minute. That's very valuable, given that hours you will save and that you can then reinvest, just like I have, into research in actually promising candidates. Do you want to screen stocks yourself using the Pulse template? I made it available at a link in the description, so check that out. And there are 2 versions. There's the regular version, which requires you to do your own data population or integrations. And there's the Pro version, which is the exact version I was using to pull up data in seconds in the video. And that already has the Bloomberg integrations fully enabled and coded. But you do need a Bloomberg subscription for that. Both of these come with a complimentary month to the paid tier of the Behavioral Value Investor Substack. I'll be doing a new video in the 2-minute pulse series every week on this channel, so please subscribe and hit the bell button. Do you want me to look at a specific company through the pulse framework? Just leave a comment on this video with a ticker and I will add it to the pipeline. I will see you in the next video.